There are a few critical metrics and financial areas that all founders of a startup should be across from a very early stage. And I'd largely group these into four critical areas. One is the strength of your revenue activity. Second is the strength of your spending and the efficiency of your spending. Third is the efficiency of your capital use, so how you're actually using the funds that have been brought in to start up your business. And lastly, the strength of your marketing activities, so your growth activities, how efficient are the dollars that you deploy on marketing and growth in bringing in new customers and actually driving new growth. So if we start with one being, the efficiency of your revenue activities and your revenue growth, this is probably the primary indicator of the health of your business, particularly in software businesses and software as a service that operate as a subscription model. The primary sort of KPI in that business will be what's called annual recurring revenue. And what this essentially does is take all of your subscriber base, multiply it by the annual subscription price that they are paying to your company, and showing that trend from a showing that in point in time first, as well as the trend over time, really shows the health of your subscription business. I guess the beauty of subscription businesses is that they are compounding, so the subscribers you bring in this month will continue to pay you next month as you bring in new subscribers next month, and so on and so forth. So annual recurring revenue, a derivative of that is monthly recurring revenue, which is essentially taking your subscriber base today, multiplying each one by the monthly cost that they pay you, and then combining all of that to get your total monthly recurring revenue, and then multiplying that by 12 is what gets you your annual recurring revenue number. So this, as I mentioned, is such a critical financial metric for a startup. This is probably the first one that any investor is going to look at or want to get an understanding of to measure the health of your business. Now, this can also be broken down a little bit further. As I mentioned, the nature of subscription businesses are compounding. That the fact that you're going to roll forward subscribers into next month and add new subscribers, you're also probably going to have people who cancel what we call these churned subscribers, so users that no longer paying you anymore. So you can actually break annual recurring revenue down a little bit further into existing annual recurring revenue, so revenue from existing subscribers that have rolled forward, new annual recurring revenue, so new subscribers that have joined in that month or period in question, and then churned annual recurring revenue, so subscribers that have left your platform. And if you combine the new and the churned, you can also arrive at a net new annual recurring revenue figure. And really getting a handle and tracking these numbers and making sure that they're trending in the right direction, that's what an investor is essentially going to look at to measure the health of your subscription business. If you're churning a lot of users and the net new is only being sustained by the fact you're having to bring in a large number of new subscribers to sustain top line annual recurring revenue growth, then that's going to indicate, even though that might be trending upwards, that's going to indicate there's some issue with the health of your subscription business, and your product is not sticky enough to keep subscribers on your platform for a long enough time without them having to be replaced by new subscribers to sustain revenue growth. And so that'd be a red flag for an investor. So tracking at that top line level, as well as looking at the breakdown of your annualized or annual recurring revenue metric is really a critical thing to get across if you're a founder of a startup. Second, if we look, sort of keep flowing down the profit and loss statement, and we look at the efficiency of your spend, this is usually expressed in a couple of ways. We can look at this from what's called a gross profit perspective, which is you're deducting direct costs attributable to your revenue. So this excludes things like the majority of wages and salaries, rent, just costs that are required to sustain your operations, that those sort of flow down into operating expenses and down into net profit, which I'll talk about shortly. What we deduct to get to gross profit is direct costs, so things like sales and marketing activities, which are directly attributable to driving the growth of your revenue. And so once things like AWS and other sort of cloud hosting platforms are sort of considered critical infrastructure costs and usually form part of your direct costs of providing the service that you are providing to your customers on your platform. So if we deduct direct costs from revenue, and that's revenue that is calculated on an accounting basis, and I won't go into too much detail on that, but for example, if you had a subscriber paying you $120 of an annual fee, you wouldn't recognize that as revenue in the month that they pay you that $120. You actually spread that out over the life of that customer and what the subscription period. So that essentially translates to $10 a month, and then that's what becomes your revenue figure for that month for when you're calculating gross profit. And you do the same on the cost side as well. If you incurred an annual cost up front, you typically spread that out over the life of that service period as well, so it sort of matches up. So if we deduct direct costs from accounting revenue, we get down to gross profit, and usually that's expressed as a margin. And quite simply, you take your gross profit and you divide it by revenue, and it gives you a percentage. A lot of software companies have very high gross profit margins. That's what makes them an attractive business, because a lot of their infrastructure costs are fairly fixed. There's some sort of attachment to the size of the business, the size of the customer base, the size of the platform, but by and large, just because of the nature of subscription revenue and the way it compounds and the sort of fixed nature of the product platform, you typically expect best-in-class software companies to be operating at a pretty high gross profit margin. 70% plus would be considered very strong gross profit margin in a business. So making sure you're also across that metric and the efficiency of your direct costs as a relation to your revenue, and making sure that as your revenue is scaling, you're not seeing direct scaling of your direct costs as well, because that indicates you don't have that highly efficient business model, which makes software companies extremely attractive. If you can scale your revenue and it has a minimal impact on your direct costs to the point where your gross profit is high and stays high, and any revenue growth can actually help to increase your gross profit margin, that's an extremely attractive and an extremely efficient business for any investor who's having a look into your metrics. Thirdly, capital efficiency. This is particularly important if you're a relatively new startup, but also if you've just taken on investment, or you've just done a seed round, you're still early stage, you're still at the point where you're not at a profitability on a net profit basis. and I'll speak to that again shortly. Essentially, it means, how quickly are you burning through your cash, and when might you need to look to raise another round, or when can you expect to hit a point where you become self-sustained and you're no longer dependent on capital injections to fuel and grow your business. And this metric's usually expressed as a cash burn rate or runway. The two are the same. Runway is probably the more common way to express it, and that's usually expressed as based on the amount of cash we've spent this month. Our burn rate and runway maybe 18 months. Based on this spend level and the amount at which we're consuming cash, we may have 18 months left of cash before we run out of cash and we need to raise. You would never let yourself get to the point where you're getting close to that zero mark of running out of cash before you start having conversations with investors. You typically wouldn't want to get any lower than 12 months because that really shows poor financial planning, potentially even poor traction, or you haven't got the product market fit that you'd hoped by that point. So you really want to be making sure you're not opening up in conversations with investors late, and you're doing that early. But runway, simply calculated, is burn rate, which is the amount of cash you're burning through in any given period, usually a month. That can be expressed in two ways: gross cash burn or net cash burn. Net cash burn allows for you to incorporate any revenue you're bringing in. So it looks at cash, sort of net cash outflow after you take into account revenue you brought in. The more conservative way to look at it is looking at gross cash burn, and that can sometimes be referred to as the doomsday scenario. So if all revenue was switched off tomorrow for whatever reason, a big competitor came in, or your platform just crashed, or there was a reputational issue and you lost a load of customers, based on your cash outflows, how much runway would you have left in that scenario? And that's just good to know from not necessarily scenario planning, but just a worst case planning scenario. It gives you another sort of gauge as to when you might want to look to the capital markets to bring in extra funding and give yourself a bit of an extra buffer. And that'll be relevant based on where you are in your product development cycle. What launches do you have coming up? How can you get to a milestone that you know is going to help propel the business? You sort of want to align those to the runway and various points in the runway, and consider that in your capital fundraising strategies. I touched on net profit, and I'll speak to that a little bit now. The net profit, very similar to gross profit, but in addition to deducting direct costs, you also deduct costs of running your business, running your operations, and the big ones there are usually wages and salaries of employees, rent costs, anything essentially that's going into supporting your business continuing to operate. And once you deduct those costs from your gross profit, you get down to a net profit figure. And typically net profit in a startup is going to be, you're going to be in a loss-making position. But hopefully over time, as your revenue is scaling, you want to see your revenue being able to sufficiently cover your costs and then more. So you want to be getting to the point where you're in a net profit position. It's very common, though, in software companies to take a fairly long time to get to that point. But it's good to just have a plan there. It's good to know that it's trending in the right direction. And ultimately, whilst it's not sort of directly correlated to cash burn, it is still a good indicator of the health of the business. Cash is typically more preferred in a software company just because of the way that they can bring in annual revenues from subscribers, and those sort of get recognized in cash upfront, whereas on a net profit basis, you're following the accounting principles where you're spreading that revenue over a year. So cash is probably more relevant for the health of the business and looking at the capital efficiency. The last metric or metric set that I'll dive into is around really the efficiency of your growth, the efficiency of your marketing activities. And this looks at how are you driving your growth in revenue and your customer base. If that's happening organically, then great. That will reflect in the efficiency. But if you're having to spend lots of money on marketing, you've got a very high cost of bringing in new subscribers. These metrics will also expose that, and it's something investors are going to look into because they want to see that you're not really just pumping up your numbers by burning through lots of cash that's being spent on marketing. And the main metric they look at there is what's called a CAC to LTV ratio. So CAC is customer acquisition cost. So what is the cost to you of acquiring a new subscriber? And there's quite a difficult metric to track, but if you've got a good sort of growth and marketing team, they should be able to attribute costs to new subscribers coming in and come up with a figure for how much it's costing to bring those subscribers into the business. And then that's usually expressed as a ratio over what's called lifetime value. And that's the amount of revenue that you can expect to generate from that customer. And so what it essentially is doing is matching the revenue you expect to generate from a customer to the cost you had to incur to bring that customer in. And if you bring, say, an annual subscriber in on a $120 a year subscription, the lifetime value of that customer isn't typically $120. They may renew after a year. They may hang around on the platform for 5 years, 10 years. They may churn after 1 year. And so the lifetime value really looks at the average amount of income that you can expect to generate from a customer that's brought in through your growth strategy. And typically what SaaS companies try and aim for here is a ratio of 3-to-1. That's usually considered best in class. So for every $100 you're spending on acquiring a customer, you should hope and expect and plan and strategize to achieve at least $300 in revenue from that customer. If you can achieve that, you'd be considered to have a very efficient acquisition strategy. Obviously, you should also be supporting growth of the business via organic acquisition means. So how can people find your product and platform and solutions via free methods, by word of mouth, through social. Those things will all help to support your overall CAC LTV ratio when it's looked at on a blended basis. So when you take into account all of your organic growth and marketing spend growth. So those are the 4 sort of critical metrics I'd say startup founders need to be really across from day one. They should be building the processes and systems to ensure that this data is accurate and is being monitored and tracked and analyzed on a regular basis, because they will also become the cornerstone of your story that you'll share with investors when the time comes to raise or do a capital raise. It's some of the first metrics they're going to ask for. They're going to also want to understand how those are calculated, the accuracy of that data, and you also want to be using that information to make important strategic decisions about the direction of your business, whether that be pricing related, whether it be marketing and growth activities and looking at the efficiency of those. getting a handle across these metrics will be absolutely critical for ensuring the long-term success.